Good morning, everybody. Monday, September 23rd, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer. This is my weekly economic and market commentary. Presentation you are seeing and or hearing in the case of an audio-only podcast is prepared by me for use with you, whether you are a financial advisor or an individual investor. Regardless, you are expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice. There's no tax advice, no recommendation for the purchase or sale of any securities. Everything is strictly for informational purposes only. The views expressed in this presentation are mine and mine alone. They may differ from the views of CFIA's parent affiliates or other portfolio managers. Well, we just keep on keeping on. Another up week. If September continues, if this week continues and we finish September up, I think it'll be the first positive September for stock prices in about 5 years. I think since 2019. September is historically a bad month. But you all know we're going to get into it. We got interest rate cuts from the Federal Reserve last week. A lot of economic activity seems to actually be accelerating, not decelerating. We're going to get into that as well. Small and mid-cap stocks kind of led the way last week. Emerging markets performed very well also. But across the board, strong performance from the equity markets. Even though the Fed cut interest rates on the yield, on the chart, on the securities the Fed does not control, actually inched up a little bit. The 2-year yield, the 10-year yield, the 20-year yield all went up a little bit. Why was that? Well, it's simply a buy the rumor, sell the fact kind of thing. So just down a little bit on the aggregate bond index and about 1.5% on the longer 20-year plus Treasury index. Moving along, one of the things I thought was interesting that we should take a look at, and I always talk to you, let me go back for 1 second. I always talk to you about, when high yield spreads widen, meaning what you have to get paid to own a high yield fund above what you get paid on a risk-free treasury or treasury fund. When those numbers get bigger, that's usually a sign that a recession is coming. And when you look at this graph here, this goes all the way back to 1994, and you can see the spread, that's high yield above treasury yield, so 10-year high yield paper above 10-year treasury, goes up, you end up with a recession. Back here in 07, going up, you end up with a recession. You go up, didn't get a recession, got a recession in 2020, and then here we are today. The high yield bond market is still flush. Not anticipating a recession at all. Interesting. Moving on. Okay, we got a couple of regional manufacturing surveys last week, starting with New York State or Empire State. It was estimated to come in at -4, and you can see manufacturing's been in the doldrums here for the better part of 2 years, 3 years almost, since the reopening from the COVID-related shutdowns, and it was a big surprise higher at 11.5. First time since November of 23, we even had a positive month. Highest number since April of 22. New orders, employment, the outlook, everything sort of turned higher in New York State. Philly Fed survey also turned positive, not quite as robustly. Philly Fed survey rose from -7 to 1.7. It was estimated at 0. Again, manufacturing in the Philadelphia region has been in the doldrums here for the better part of a couple of years. Here, though, new orders and shipments both fell. Employment got a little bit better. Expectations pretty much unchanged. We also had a good reading, a surprise positive reading on retail sales. One of the reasons why, there's multiple reasons, you've heard it from me before, why I thought maybe it was not the right time to start cutting interest rates. I certainly would not have voted for 50 basis points, and I've been a voting member of that committee. But they've done it. It is now in the market. And one of the reasons is data's been pretty good. And there's really not a lot of slowdown signs. Retail sales up 0.1% in August. They were expected to be down 0.2%. Even backing out autos and gas, we were up 0.2% as well. So strong data from the nation's consumers as shown or manifested in the retail sales number. Now, we got industrial production and capacity utilization for the month of August. Here's what's interesting. Production was expected to go up 0.2%. It went up 0.8%. That's a pretty healthy, it's not unheard of, but it's a pretty healthy spike higher in industrial production. Manufacturing production also rebounded. But here's what's interesting. Capacity utilization is a great early gauge of inflationary pressures. And I've been saying for some time that we do have a risk of a reacceleration of inflation in the economy. Why is it a good indicator? Well, as the capacity gets taken up, that means there's more demand for all the resources, there's more demand for labor, more demand for things, generally causes price to go up, all things being equal. It is often said that when you get to about 80, you really have got some significant inflation rolling into the economy. And so we're not there yet, of course, but it was a big surprise to go from 77.4 to 78, although the estimate was right there. It was 77.9, same thing. So just, a possible early sign of some inflationary reacceleration, nothing to get too excited about. We also got a lot of data last week on the housing market. Let's start with housing sentiment. The National Association of Home Builders September Housing Market Sentiment Index rose to 41. That's a miserably low number. 50 is the line of delineation. There's 50 right there between expansion and contraction, or optimism and pessimism, I should say. This is a sentiment indicator. Current sales up a tad. Future sales actually got positive. Why did that happen? Well, the anticipation of the rate cuts is an anticipation of a return of housing market activity, and traffic incredibly low, but up from 25 to 27. Housing starts and permits, same kind of thing, right? This is anticipation of lower rates, anticipation of easier financing, availability for home buyers. And so housing starts up 9.6%, well above expectations. Building permits up about 5% after falling 3% the month before. So starting to see a little pickup there. Where we're not seeing the pickup yet is existing home sales. Why? I think they remain in the doldrums because, well, if rates are going to be cut, whether it was September, November, or whatever, why lock in a mortgage now and let's wait 30 or 60 or 90 days? And that's what buyers have been doing. A, prices are ridiculously high, and two, interest rates were high. So they've been just holding off. And you can see here, existing home sales fell 2.5% and are down 4% from a year ago. And that is just in terms of the number of units, we are getting well below 4 million annualized, which is a very, very low number. So if you have any friends that are in the residential real estate business, whether they're doing title or insurance or sales or remodeling, you can bet they're having a rough go of it, and they will be very excited for the Fed's rate cuts that came last week. Initial claims for unemployment were down substantially. The estimate was for 230, came in at 219. Anything, I say this every week, below 300 is good. Down touching near 200 is amazing. We have a very strong labor market. This was the lowest reading since May. So if the Fed says we're cutting rates to get ahead of possible slowdown in the labor market, they got no evidence of that slowdown last week. Continuing claims fell again to 1.829. So strong labor market continues. Obviously, the big news of last week was Federal Reserve cutting interest rates, the Fed funds target rate, the upper bound of the Fed funds target rate by 50 basis points. The expectation was 25 for sure, 50-50 chance of a half a point or 50 basis points. They did that. I think they also signals there probably another 75 before the year is up. Could be another 50 in November, 2 days after our general election, or it could be 25. But the futures markets now are all anticipating at least another 50 to 75, even possibly 100 by the end of the year, which of course is right around the corner. Why does this matter? Well, when the Federal Reserve cuts its Fed funds target rate from 5.5 to 5, cut by 50 basis points, that makes the money more available to other institutions. If money is more available to other institutions at more favorable rates, they can drop their rates to businesses. Businesses then create more activity. Therefore, you have this stimulus that comes into the economy. Taking a look at some of the rates, right? Banks often charge businesses for business loans prime plus. So the U.S. prime rate plus a margin. I say 1% or 2%, depending on the credit worthiness. You can see it had been at 8.5%, 8.5%. The day after the Fed cuts, drops to 8%, exactly a half a point. Secured overnight financing rate, also called SOFR. This affects many different types of loans, including brokerage loans, some adjustable rate mortgages. And you can see kind of hovering around 5.3 to 5.4, 5.35%. And you can see that had a major drop down here to about 4.8, which is, again, exactly a half a percent. So the Fed doesn't control these rates, but these rates price off of what the Fed does. LIBOR, which is sort of being phased out, 5.5. You can see that down below 5. And then the yield on the 1-year Treasury bill, which is what it costs the United States Treasury in terms of interest to fund the operations of the United States government, that had been coming down for a while in anticipation of these rate cuts. And as you can see here, down and to the right. So this brings down the deficit financing costs, the debt financing costs, I should say, of the United States government. Next, we've got this week's economic data. We've already got this morning the flash September manufacturing and services PMIs from S&P Global. And I happen to know, because I could see it over here on my screen, both did perform better than the consensus estimate. We'll talk to you about that next week. Tuesday, home prices from both FHFA and Case-Shiller, along with consumer confidence, new home sales, jobless claims, second quarter GDP, expected to be revised down from 3.0 to 2.9. Okay, we'll see. Durable goods, pending home sales, Friday, personal income spending, and the big one, the PCE price index. I would think the Fed has some visibility on this, or maybe they wouldn't have cut those 50 basis points last week. But the estimate there is that it comes in up 0.1% on a month-over-month basis. Then we've got consumer sentiment. Follow it all up. And I thank you for tuning in. Don't forget, YouTube channel, Slaying Bulls and Bears with this guy, Herb Morgan. If you are audio only, any one of the following listed podcast formats will play this podcast, Slaying Bulls and Bears with me. Thanks. I'll see you again 1 week from today.